This webinar. I've got Effie Zahos with us. So thank you very much, Effie, for getting on board with us. Effie's a non-executive director, and she also joins me on the investment committee meeting that we have every quarter. Today, we're going to have Steph helping us with the slides. So I'm going to be saying all the time, Steph, can you put it on the slides like now? Because we've got a problem with the webinar and I can't control it. So Steph's going to help me. So Steph, can you go over to the webinar, please, Dom? And the next slide. So this is just the disclaimer. It's general advice only. I think it's pretty common to most of these webinars these days. So it's actually our 25th year anniversary. So next slide, Steph. So it's a quarter of a century. It's a long time, even though today we're going to be talking about our three new debutante portfolios that we launched in 2014, our growth, high growth, and our international portfolio. But InvestSMART's actually been going for 25 years.
Yeah.
And this is also our 25th year. It's a bit of an echo somewhere. And so it's a good time to sort of like have a bit of a reflection on our past and the sort of problems we saw over the last 25 years and even still today, and how we set about sort of trying to fix those problems we saw over the last, especially sort of 10, 15 years ago. And then how that's actually helped us to outperform the fund managers over the last 10 years. And we're going to share some of those ways that you guys can also do it in your own investing in own portfolios, or at least know how we do it. So the next slide shows us the sort of biggest problems that we saw. So when InvestSMART started back in 1999, we actually distributed other people's managed funds and products and IPOs. And some of the biggest things that we sort of saw was the high fees. And Effie will remember the high fees back in the sort of like early 2000s, entry fees.
Yeah, you had the entry fees at like 5%, 6% was quite the norm, wasn't it, Ron?
Correct.
And then not only entry fees, there was exit fees. So for a lot of first-time investors, I don't think they realise just how much products and fees have improved, but still how much there is to go as well. Because and I know you're going to talk about it later, the fees that have a huge impact on your investment returns. And back then, I know when InvestSMART started, I think I was a journo writing about some of your fee-for-service kind of rebates that you were doing and so on. But yeah, 5-6% entry exit fees were not unusual.
Yeah, which is ridiculous, because if you're paying 5% as an entry fee and you put in $10,000 and it's a dollar unit, you lose $500 before you even start investing. So you only get 9,500 units, and the rest of that money goes to financial advice. And a lot of stuff's been done over the years, as we know. Future of Financial Advice came in, the Royal Commission. A lot of things have happened to bring fees down, but the fees are actually still high today, especially compared to someone like an InvestSMART. Yeah. The other thing we saw was ambulance chasing returns, and I think that still happens today. You go to a barbecue, you see Bitcoin, you see whatever else on the
That's hard to avoid, but isn't it, Ron? That is very hard to avoid, because a lot of behavioural economics comes into that, doesn't it?
Correct. And the problem is, though, is people sort of like chase those returns without actually thinking about what they're trying to do and what goals they're actually trying to achieve. And I actually put that down to that's gambling, not investing. Yeah. I think there's a big difference. If you want to gamble, go to the track, go to the casino, you know how much you're going to spend, do that. But if you're investing, there's some systematic ways and processes to do that enables you to reach your financial goals and also beat the majority of fund managers, which we're going to talk about today. The other thing is setting and forgetting and not rebalancing. So a lot of people, they'll buy a fund and then they'll set it. I mean, fund managers love retail investors because, and InvestSMART loves retail investors. You guys are sticky. You don't generally leave, even though the performance could be poor. It could not be, the funds you're in or the investment portfolios you're in aren't aligned with those investing goals you sort of like set, or, you didn't set in a lot of cases. And so, we think that's really important, and that's part of the systematic way of investing that we're going to show you today. And I think the last one is trying to time the markets. I think even professional investors continue to do this. It's very hard, to look at the media, look at sort of like short-term noise and events. Lots of countries are throwing bombs at each other. Different presidents are getting in and not getting in. There's a lot of noise where people go, oh, I might sit on the sidelines now. And we're going to talk a little bit about that as well.
Yeah.
And as I said, many of these problems still exist today. And so that's what we've sort of like set about to try to fix. So let's just go quickly into some of those problems in more details. If we can go to that next slide on the high fees and underperformance. I only looked at these figures from October 2024. So most of this data comes from Morningstar, and I've just sort of like compiled it in a different fashion. So if we look at the 3 different funds that reached 10 years this year, which is our growth portfolio, high growth portfolio, and international portfolio, and we look at just the benchmark and those peer funds that exist in the marketplace, there's probably about 2,000 of those funds that we would call our peers. And
do you want to explain that, Ron? Can you just explain that a little bit more, what those benchmark funds are? Just a little bit more.
So for the growth portfolio, we benchmark that to the Morningstar multi-sector growth portfolio. Growth benchmark, which is a benchmark of all sort of like peers. And there's about 300 different funds available in Australia that we would consider peers for that fund. And then for the high growth, it's the Morningstar High Growth and benchmark. And then for the international, it's the MSCI ex-Australia benchmark. And there's about 2,000 or 1,600 sort of funds in Australia that we would compete, or we would call our peers, in those 3 portfolios. 83% of those funds underperformed their benchmark over the last 10 years. So just looking at 10 years, and those funds that have had performance for that 10 years, 83% of them underperform their benchmark. Now, out of those sort of 1,600 odd funds, their average fees were 1.35%, and their extent of underperformance is 1.72. So the fees make up a large part of their underperformance, because obviously a benchmark doesn't actually have fees. It's just a mathematical equation. Like the ASX 200 benchmark, or as an index, would just be the 200 stocks listed on the stock exchange by market cap. Yeah.
And that's the one thing too, Ron, I guess, when you are looking at, what, investments that track an index, you can't control that. If it goes up with the index. If it goes down, it goes down. But that's one thing we can control when it comes to where we put our money. What are the fees we're paying? Whether it's an ETF, whether it's a super fund, your money in super fund, have a look at your fees there as well. That's one thing we can control. But, as you point out, a lot of us become complacent and don't look and just see, well, what fees are we paying and how does it compare with the peers?
Correct. And a lot of people don't do this work of working out, most of the underperformance of these funds. And there's lots of reports. There's the SPIVDA report. There's lots of reports that show, not only in Australia, but over in America, that everywhere in the world, that most fund managers underperform their benchmark to pretty much the cost of their fees, or the fees actually play a large part of it, because a benchmark as such doesn't have fees, whereas a fund manager has to go and buy and sell stuff, pay brokerage, blah, blah, blah. So, the fact is that most fund managers underperform their benchmark, and fees really do matter. And fees, if you have a look, Money Smart government website does some good stuff around fees. 26% loss to fees of 1%, 45. This is over 30 years. So, if you're paying 3% in fees, and we'll come back to that 3% in 2 seconds.
But how many funds are sitting at 3% right now?
Well, no, that's what I was going to say, Effie, because most funds, as I said, it's 1.35 for those peers we're looking at compared to our 3 funds, our 3 portfolios. So that's 1.35. But then you might be buying that on some sort of platform like a Net or a Harp24 or a Panorama, BT Panorama, Colonial First State, Perpetual. those platforms also have fees that's on top of. So that 1.35, so we call it stacked fees. So that 1.35 is just for the fund manager. Then depending on where you buy it through, there's a platform fee. And then if you're buying it also, you're going through an advisor might charge 50 basis points or 0.5% or 1%. You add all that up and you can easily get to 3%. We have a lot of clients who come to us and go, Jesus, we're paying 3%. I can't believe you guys charge, 55 basis points or whatever it is. So you can get to, when you stack it up between
financial advisor fees and the rest. Yeah, sure. Okay.
Correct. So that's the sort of like underperform, high fees. And we talk about this a little bit later, Effie, about you don't, it's one of those industries where just because you pay more doesn't mean you get more or get better. You really have to be careful of where you're invested and keep an eye on those fees. And if we go to the 1 year performance slide next, what I did here was I actually looked at all fund managers across all asset classes, across, what the 1 year is. And I don't know if everybody can see that, but the blue is actually the, let me put my glasses on, I can't see.
Total return.
That's the fund total return. So that's the average performance of all of the fund managers in each of those different sectors in Australia, or at least reported by Morningstar. So this is only those fund managers, which is pretty much the majority of them that Morningstar covers. And you can see that the blue is what the average funds return, and then the index total return is in the orange. And you can see pretty much on a 1 year basis, so this is 1 year performance as at 31st of October 2024, that most fund managers on average do not beat their benchmark across all categories. And then if we look at the 2 year relative performance, you see a similar sort of picture. Again, it's the next slide shows us the grey is the fund managers, the gold is against the benchmarks. So again, you can still see that on average, most fund managers do not beat their benchmarks on a 2 year. And then if I look on it on a 10 year basis, again, you see the exact same thing. The dark grey is the average fund managers, and the, I don't know what you call that, darker gold is the benchmarks. So it doesn't really matter how I sort of cut and dice the data. And as I said, there's lots of research out on this. The majority of fund managers don't beat their benchmarks, and the majority of that underperformance is due to fees. So the first thing you can do to beat the fund managers, and I'm giving it away early in the piece, is keep your fees low. And we'll show you how you can do that. Ambulance chasing returns. I think this is a really interesting one. And Effie, you had a large part to do with this report in the next slide, which was our recent ETF scorecard for 2024.
So, this was a really good report that took us a while to put together. It's going to be an annual one for InvestSMART. Basically, as you said, Ron, we kind of picked the market out between best and worst in different categories, different sectors. And what I also like about this report is that even though, your top ones here, the best performing over 1 year, it is just 1 year. We then have at the back of the section the ETFs that we rate with a 5-star, looking at a number of variables. They're tracking out, they're outperforming their fees and so on, and score it a 5-star. So you look at 5-year returns and what actual star rating it got. But as Ron's probably going to point out now, it just goes to show that the old saying, this year's winner could be next year's dog, so to speak. If you get it right, you get it right, but that's not basically the gist of investment. And things can turn around very, very quickly. There's a big difference there between the top performing versus the bottom performing over a 1 year period.
Yeah, correct. And I again, put this down to gambling, not investing. If you have a look at the best performing over 1 year, and 1 year is a very
here, isn't it? Sorry, Ron.
Yeah, over 1 year, it's a very short time frame, and we look at much longer time frames. But even over 1 year, if you invested in the BetaShares Geared US Equity Fund, and that's really That's gearing, and the majority of those returns on that came from what they call the Magnificent Seven, the Googles, Facebooks, Tesla, etc. You would have made 46%. But if you had a look, if you went for sort of like short NASDAQ, i.e. the opposite, you would have lost 40%. But across all of those two, the left-hand side is the best performing and the right-hand side is the worst performing. There's stuff like climate change, semiconductors, there's all these sort of like thematics. And if you got it right, you made good money. And if you got it wrong, you lost good money. And there's much better ways to invest than trying to, pick the next sort of like boom in a different place. And I just, if you want to do this, just make sure there's a very small part of your portfolio that's doing that, and what we call core and satellite, and have the core of your money in widely diversified portfolio. And then, if you want to sort of like go for some more of these sort of sideline bets, then make sure you don't use all your money to do that.
I think that's the key. And you can download that report that's on the website there if you want to dig a little bit deeper into all those funds.
Yes, correct. And we're also going to share these slides with everybody. So there's sort of like links to these reports and you'll be able to see those as well. So the next slide actually shows you the sort of last one, which is, well, actually last two, or the second last one, which is rebalancing. So rebalancing, I call it, in financial planning speak, they call it sequencing risk. I call it Murphy's Law. We all sort of like know what Murphy's Law is, which basically says, expect the worst thing to happen at the worst possible time. And so what that means is, if you do set a goal, and your goal might be 20 years retirement, and because it's 20 years, you can afford to take on more risk, and so you go for a growth portfolio or a high growth portfolio. The problem is, as you get closer to retirement, you need to reconsider your goals, your objectives, and time horizon. So just because you start off in a portfolio when you're 30, 40 years old in growth, doesn't mean when you reach 60, 65, you should still be in a growth portfolio when you're only a few years away from retirement. And that's called sequencing risk. And it happened in the GFC, where a lot of people might have started off in a balanced sort of portfolio when they were nearing retirement. They went and saw a financial advisor in 2019. The financial advisor did the right thing and said, hey, you're retiring in 5 years. You should be in 50% sort of cash and bonds, and 50% in sort of growth assets like international Australian equities and property. And then remember, the lead up to COVID, we had that massive sort of upsurge in equity markets. By the time you got to the GFC, your balanced portfolio, if you hadn't rebalanced it, would have looked more like a growth portfolio or a high growth portfolio. GFC happens, you lose half your money just before you're about to retire. That's Murphy's Law, that's sequencing risk. It's why you've got to continually, not all the time, because you'll chew up, costs and transactions and taxation, implications. But we, as we're going to talk about, we do our investment committee meetings here every quarter, which Effie's a part of, and I'll take you through how we look at those things. But even if you do it once a year, you need to make sure that you've set the goal, whatever your objective is, whatever your asset allocation is, make sure it's sort of like stays aligned over time as different asset classes move up and down. And that's really what rebalancing is all about.
And I think that was key too, Ron, what you said. You don't want to be doing this every single day and freaking out, well, what's happening with the noise around. But it is really important that you do look where you are with your goal, where your age as well, what you want to get into, and not just with your investments in ETFs or shares or something, but even again as you get older into your super as well. Although a lot of those super funds these days do automatically rebalance as well. But
yes,
for us,
correct.
Yeah.
Well, only if you chose that option in super. There's a lot of people who probably started off in growth, high growth, and 20 years later they're still in high growth.
Although the industry is changing, Ron, I know a lot of the super funds are changing their products to lifestyle. So you'll probably notice a few major ones would have sent out a notice saying, hey, what was a balance now is going to become a lifestyle product. So something makes it a little bit easier for consumers. But if you're just purely investing ETFs or shares, that's something that you still have to do yourself if you don't have a portfolio.
Absolutely. And so the next slide, I think, is our last sort of problem that we saw over the last 20 years, and this definitely continues to happen today. It's one of my massive frustrations in life. I sound like a broken record all the time, Effie, telling people, including my wife and my children, that you just don't time the market. The best time to invest is now, and we're going to talk about a little bit of that but we're going to talk about, why you don't market time. But just to have a look at, and there's 1,000 studies out there. Just Google it. You'll be bombarded with literature on it. But, the 2016 Delbar study, which is a pretty famous one, it had a look at average investors. This is over in the US. They didn't stay invested long enough to reap the rewards that the market can often offer disciplined investors, which is pretty much compounding interest. Yeah, let's face it, that's what happens. The data also shows that when investors do react, when they do try to time, they usually get it wrong. So they buy at the highs and they sell at the lows, which is the opposite what you do to actually make money. So, there's the FOMO at the top of the market. Oh, I'm missing out. All my neighbours are making all the money, so I better get in. That's usually the top. And
it is, and also just fear of jumping in. You've got FOMO, but you've got fear of jumping in because you're just not quite sure.
Correct.
And if I can jump in just here, I know if that is you, that you're just worried about, when do I jump in? Have I missed the boat? Is it too late? I'm worried about this or that. It all comes down to education, and doing something like this right now is your best thing that you've done, in the sense you've started your education journey, continue it. I mean, I know even when I was working in InvestSMART, we did an investment quiz, Test Your InvestSMARTs. And again, I urge you, if you haven't done that, that is online. It's a great quiz, 15 questions. The median score was 5 out of 15. 74% of Aussies failed that test, which just goes to show that the investment journey, we still have a long way to go when it comes to building that knowledge. But super proud that, people are taking the effort and doing it. So if it is that fear of jumping in, just continue your investment journey, because, I always say that knowledge is power, and this is a great way to start.
Yeah, and I also think that hopefully this process that we show people today, this systematic process of investing, it takes away all of this fear and greed of buying high and selling low, which is the exact opposite of what you're supposed to do. So basically you halve your returns by trying to average time the market. I think the next slide, and I threw this in just because, obviously Trump just got in. I think it was interesting. So this shows, if you put in $10,000, and this was done by Schwab in the US just before the recent elections in the US. But if you invested only under a Republican president, so let's say only when a Republican president was in, you invested your 10 grand from 1948. You then went to cash when the Democrats got in, and and so forth. Then during a Republican president, you would have taken your $10,000 to 311, and the Democrats, won. You would have been 1.2 million. But if you actually just left your 10 grand invested over the entire period of time, you'd have nearly $38 million. So basically, it's irrelevant who's the president.
Yeah.
And I know
it does make some great discussion, Ron, doesn't it? I mean, what's happening to Bitcoin, the S&P 500? I tell you what, I'm actually really enjoying the ride at the moment.
I was expecting the comments sort of to light up with everybody going, I hate Trump, or I love Trump. Anyway, basically from my point of view in investing, and what we're showing you today, the systematic way of investing, it doesn't matter. And there would have been a lot of fund managers, by the way, that were caught out with trying to time the market. As I said in earlier slide, even professional fund managers and investors can't help themselves. So there would have been people making bets that he didn't get in, or made bets that he did get in. At the end of the day, there'd be losers, there'd be winners. So it doesn't really matter.
Yeah.
So let's get on to how we do things, and why we believe we do beat the majority of fund managers, and how you guys can do it. So this is, as I said, we've just turned 10 years for these 3 first investment portfolios we launched in October 2014. We're very proud of them. The next slide shows you the results of those 3 portfolios. And as you can see, sort of like, so we're comparing ourselves to peers here. InvestSMART's in the blue, and over pretty much every time period, we beat the majority of, in yellow, the majority of our peers for each of those portfolios. So the growth portfolio, which is that top right-hand corner one, the peers, there's 348 funds we compare ourselves to. And so that's how we've done over 1, 2, 3, 4, 5, 7, and 10 years. And the last one is since inception, which is pretty close to obviously the 10-year because, we just hit 10 years on, I think it was like the middle of October. The high growth portfolio in the bottom left-hand corner there, same sort of time period, 1 year to 10 years. Again, we've outperformed the peers in that. And if I actually showed you, and I should have showed you, I might actually change the slide before I send it out to everybody. But again, you'll find its fees. We're charging 0.55%. The average of these guys, as I showed in that slide before, is about 1.35. So if you beat them on average by 0.8%, you compound that over 10 years, you start getting this sort of like, not only are you beating them each year, but it compounds to be even larger over the longer period of time. And that's exactly how you guys can do it in your own portfolios. If you can keep the fees low and lower than what a fund manager does, and you can be as diversified, and we'll show you how to do that in a minute. But as long as you can do all that yourselves, then you'll be able to beat these fund managers. So we go to the next slide. This is sort of an interesting way of how we look at it. And Effie's already made a comment that SMART is also used in lots of other acronyms for project management and time management and whatever else. So I can't remember if I stole this back in 2012, but I've basically redid it for my own purposes. So interesting enough, we look at, and so this is really for our retail investors, which is set goals, make a plan, asset allocate, diversify, rebalance, track, and monitor. But even this is a very similar process to what Effie and I, Paul Clitheroe, Alan Kohler, our portfolio managers, and Alistair Davison, our head of funds management. Every quarter we sit down in where I am today in our boardroom, and we discuss our portfolios every quarter. It's an investment committee meeting, and we take it very, very seriously. Rather than setting goals, we don't really set a goal as such. We set an objective. So we look at pretty much all the goals we think that our members would need, whether that's short-term goals such as saving for a holiday, saving for a car, short-term emergency, whatever it is. There's short-term goals and there's medium-term goals such as buying a home, and then there's long-term goals such as retirement. We sort of like we've created 9 portfolios now that we believe sort of cater for most of those goals. The 4 major ones, I guess, 5, I guess, Effie, is the conservative, balanced growth, high growth, and we also have the ethical option for those people who are more ethically conscious.
Yeah, and most people would realise, well, I hope that, you're conservative. Obviously, you're not going to have, money in there in your equities and your internationals. It's highly more positioned to cash, fixed interest, that kind of stuff. And as you go up the scale, the risk increases. And then fairly simply, if it is short term, you don't have time on your side. So, you'd be looking more for a conservative. If you've got time on the side and you've got a long period, then you can move up the scale and increase your risk. But for us, when we sit in an investment committee, especially the slides that Ron showed before, is essentially what I see. And for me, the main thing is that, are we meeting our objective, matching those needs to the goals? What's our performance there? Are we staying on track with the index? And really, if we're doing our job right, the fees are low, they're set, our returns should look good, and we should be, meeting that goal of for our investors as well.
Yeah, and I think so this is, I totally agree with that, Effie. If our portfolios are outperforming the benchmark by a lot, Paul Clitheroe will go, why are you outperforming the benchmark? You're supposed to be the benchmark, less your fees. So if we're beating the benchmark, it means we're taking on more risk than we should be to actually beat the index. And the same as if we're underperforming performing the benchmark. Why are we performing? We must be useless if we can't track the benchmark. You know, the ASX 20 is just by the top 20 by market cap in the right weights, and you should be the benchmark less your fees. So, you know, our investment committee meetings are always quite fun because we do all this algorithmically. So there's nobody sitting in our board meeting going, I think Trump's going to get in. We better go, you know, less international, or, you know, more this or less that. We don't have those discussions. Our discussions are purely around what is the objective of the portfolio? How are we set about to, you know, making a plan? What are the parameters? What's the algorithms that actually are used to work that out, and are they still working? What is the asset allocation and diversification of that benchmark we're following, you know, that objective? Making sure, you know, do we need to rebalance because maybe international equities has gone flying up, and you know, maybe we need to take some money off international and add it to cash because now we're overweight international, underweight cash.
Yeah.
And that's what rebalancing does. And so just think about that for a moment, Effie. Like, and I know you know this, but for everybody listening, if internationals have just gone flying through the roof, what most people are doing is patting themselves on the back going, wow, how great am I? It's going to now double again from here or triple from here. I'm going to be rich, you know, next year. Inadvertently, what usually happens is it then crashes or comes back to earth. By us sitting at the investment committee meeting, and by you guys sitting at home and looking at your portfolio every quarter or every year, you should actually be going, well, wait up, international equities now make up 40% of my portfolio rather than my goal or objective, which was 30%. And my cash is underweight, so I should take 10% off international equities and add it to cash. So what I've inadvertently done is I've sold high because international equities is high, and I've put it to cash. I've sort of like banked it for a little while. And then if the market does come back, or when it does come back, you've got more cash to actually buy international equities because now it's undervalued, and, you know, you're buying more international equities when it's low. And so that's systematic investing. You're not worrying about what the media says or what your neighbour or your barbecue tip says. It's purely going, am I following my objective? Do I need to rebalance? And
you explained that really well, Ron, because that's kind of what is happening now, isn't it? International equities have taken they're ripping through and have done really well. And Correct. It does become a bigger part of your portfolio. And then, like anything, when they resettle, readjust, you've got bigger amounts to lose, I guess, if you don't rebalance. So, no, you explained that very well.
Yeah. Correct. Sorry, I was reading some comments, which I'll answer some of the comments as I go as well. So, setting and making a plan. So, assess your goals. You know, what are they? I think we've actually already talked a bit about these. So, you know, are you buying a property in 5 years? What's the time horizon of those goals? I saw some comments before about even in retirement these days is a fairly long period of time, hopefully for most, because, you know, medicine's got so much better, we're living healthier, and hopefully we get to enjoy a lot longer in retirement. And there might be other goals within retirement. So again, it's setting goals. So you might have more than one goal. You know, you can have more than one goal, and you should have a portfolio set against each of those goals. That's how I do it, but you know, some people just throw it all into one bucket, as long as you've got a goal, yeah? And so in retirement, your goal might be, I need this much income for this amount, for every month. And my other goal is I might actually want to leave some money for the kids. I'm not going to, but, you know, some people do. I'm going to spend it all. You know, my investment in my kids was education, Effie, so, you know, they're on their own.
No, I'm laughing because I agree. No, absolutely.
Yeah. So everybody's got goals, and even in retirement, you still got goals within retirement. It could be to travel once every 5 years, and so you've got a little short-term goal to save towards that. Investment time horizons give you a great insight into the level of risk, as we've discussed. Effie talked about that before. So we consider 0 to 3 is conservative, 3 to 5 is balanced, 5 to 7 is growth, 7 years or longer is high growth, and that's obviously just a proportion of cash and fixed interest you have to the growth assets like international equities, Australian equities, and property and infrastructure. Obviously, conservative, you have way more money in cash and fixed interest, where you've got capital sort of like preservation, and in those longer time horizons, you can afford to invest more in those growth assets where you've got more time to ride out the ups and downs of the market.
And I think you're going to go into this a little bit later, but it's really important to understand that when you are looking at, say, a balance profile across, different providers, whatever you may choose, just really understand what is the asset mix in that, because a balance isn't the same for everyone. A growth isn't the same for everyone. So it's important to compare apples with apples when you are comparing performances as well. But I think you're going to go through. Yeah.
Absolutely. And I think the last part about this, which is getting to that point, I guess, Effie, is, plan and research. So plan how you're going to achieve your goals. What sort of diversification do you need? As Effie says, we look at sort of all of our peers, and that's a great question, Bob. So Bob just asked, what's the difference between rebalancing and timing the market? Rebalancing, I just want to answer that one straight up. Rebalancing happens systematically. You don't care what the market's doing. Yeah. You're just going, the market is that asset class has gone through whatever your objective was. So when we come to this plan and research so setting your goals and then plan and research, if you go, well, I'm a sort of a balanced person, or I'm a growth person, I've got 5 years to invest, and I'm going to put in 25% into Aussie equities, I'm making this simplistically, 25% in international equities, 25 in Aussie equities, 25 in cash, and 25% in bonds and fixed income. So I'm sort of 50-50, forgetting sort of property and infrastructure, which is that fifth sort of asset class. But let's just say you do 25, 25, 25, and international equities goes flying through the roof for Bob, which it doesn't really matter whether Trump got in, it doesn't matter. We don't care. If that then doubles and now you're 50% in international equities and now you're underweight Aussie equities, underweight fixed income, underweight cash, you automatically should look at rebalancing and taking some of that money out of international equities, i.e. selling international equities, and putting some of that into whatever you're underweight in.
Yeah.
Whereas timing the market is purely reacting on some hunch or something that's happened, some short-term noise that's happened in the marketplace that's made you think, oh my God, the market's going to crash. I need to take all my money away and put it into something else.
Yeah. So essentially in that first example, because the international equity market has done so well, your piece of that pie has just grown so much, and it now takes up a considerable bigger portion of your portfolio. So through no fault of whatever you've done, well, it's not a fault, it's nice to have that growth. You actually don't have to do anything. This is all automatic, and it just becomes a bigger part of your parcel because of the growth.
Correct. And Effie, it's systematic. It's unemotional. There's no emotion involved. And the other problem with timing the market is, as that Dunbar study showed, is most people make the wrong choices.
Yeah.
i.e., so when people try to time the market, it's usually all on or all off.
Yeah.
i.e., they will sell everything and go to cash. And then they'll miss, as you're about to do at your ASX Investor Days, Effie, they miss the biggest, there's days where the market goes up 10, 15%. And by sitting on the sidelines in cash, you miss some of the biggest days up. And so that's what we're talking about with rebalancing is we're not taking it all off. We're just taking it from 50% international equities back to 25%.
Back to what your goal was, what the proportion was originally.
What the goal was, yeah. Now, you might have also, 2 or 3 years might have passed in rebalancing, and you might be 2 or 3 years closer to your financial goal. So you might now also want to change your target allocation and go, well, actually, I don't think 25% international equities is appropriate anymore. It should only be 15%. So now you've got to go from 50% back to 15%. What I'm talking about is it's pure systematic investing. There is no emotion involved. And that's the difference between market timing and rebalancing. And so there's a lot of tools and calculators on InvestSMART. Most of our members know that. So you can go, they're all free, which is much delight to our board that Effie knows.
I'll stay free.
And so there's lots of educational tools, calculators and whatever else that helps you sort of like work out what asset allocation is good for you, work out what goal, what sort of time frame your goal should be. You can do the get started on InvestSMART. It takes you through sort of like a bit of an investment sort of scenarios of what you're looking to achieve and what sort of asset allocation or diversification is right for that sort of goal. So getting into asset allocation, the next slide. So this is sort of like we're sort of jumping all over the shop, guys. So, but this is just a typical. So this is one of our 10-year debutants growth portfolio, and you can see on the right-hand side what most people consider are asset classes. The 5 major asset classes is that cash, fixed interest, which is bonds. Probably even term deposits go into that. Yeah. Then you've got Aussie equities, international equities, property and infrastructure. Now, there are lots of people who say there's way more asset classes than that, and that's really just drilling down and being more granular in each of those major asset classes. So obviously under Aussie equities might be small companies, might be mining, But generally speaking, there are 5 asset classes, and the major thing to consider is what is your time horizon, what's your goal and what's your time horizon. If it's a short-term time horizon, then you should be allocated more to that cash and fixed interest where you've got capital preservation and less to those growth assets, which are international equities, Aussie equities, and property and infrastructure. Mm-hmm. Now, when you move from conservative, so conservative might be 70% in those income assets like fixed interest and cash and 30% in the growth assets. Then when you move to balance, it's more like 50-50. And when you move to growth, it's like 70-30. Some people, and I actually think this is quite cool, what you were talking about before, Effie, with the super funds and lifestyle super funds. You take your age off 100. And so if you're 30 years old, then off 100 is 70%, and that's what should be in growth assets. So 30% in fixed income and cash, 70% in growth. If you're 50 or over 50, you should be moving more towards a balanced, because 50 off 100 is 50. If you're 70 years old, this is talking more about retirement, so not talking about that other person. I'm sorry, whoever it was, I can't go back in the comments now, but whoever was talking about, there's lots of other goals within retirement. I'm just talking about specifically around retirement. You take your age off 100, and that's sort of like your asset allocation, which will come from, you're starting off young in the high growth, and then as you get older and getting closer to retirement, you should be moving more towards a conservative portfolio. So asset allocation and diversification, this is a really important point.
I'll just pull that up. I think, sorry, Ron, I just noticed Mark, and you might have touched on it when you say you're in retirement and you've got to go, reduce your risk. I'm sure you'd agree here. Yes, obviously, retirement is a long time for a lot of us. So that does not necessarily mean, it goes back to your own goals, your risk profile, and so on. So what he's saying is don't underestimate your investment time horizon. Totally agree with you, Mark. I guess you're 60, you still got, which is a terrible problem. We're living longer. We just need to make sure we've got money there. So yeah, you do have time on your side, even at 60, 70. Of course you do.
And Curtis just sort of and so we're sort of looking at some of these comments. We'll have plenty of time after these slides to talk about questions as well. But Curtis sort of said, why is there more, given that, the Australian market only makes up sort of 2% of the world market, why is there such a high allocation? It's mainly to do with tax and dividend imputation and that it's more, we know more about the Australian market than we do elsewhere. Interesting enough, we looked at we looked at another company's data. So we take Morningstar data, but we looked at a company called Financial Express, FE, which is basically the dominant data provider in the UK, and we looked at all of the stuff, how we systematically invest in all the algorithms. And interesting enough, over there, the UK, it's really, don't call it Australian equity, call it domestic equities. And so wherever you're located is, so if you're in the UK, you would find that domestic allocation to UK stocks would be higher, because obviously there wouldn't be any Australia. So it happens all over the world. It's got to do with tax. It's got to do with transaction. It's got to do with foreign currency exchange. Obviously, the Australian portion's not going up and down due to FX as well. So there's lots of reasons why you are more comfortable with your domestic environment.
Can I ask a question though, Ron, with our growth portfolio there? I mean, really, it's like, almost 50-50, isn't it? Aussie equities 29, international equities 30. When this first started 10 years ago, was international equities considerably less than Aussie equities?
Yeah, absolutely.
Yeah, I would have thought so. And that's the thing that I'm noticing. I mean, I look a lot at super funds as well, and there's been a big change if you have a look at, say, your even balanced super fund, how much that's changed. International equities, almost balanced funds. I was looking at super ratings data has overtaken Aussie equities. So I would have thought when we first started that, it wouldn't have even been that high, but because of obviously, we are becoming more global and so on, and it's important to have it in there. The split's there, but as you point out,
it's a lot easier to buy direct equities, international direct equities on most broker stuff now. But ETFs, like the last point of this is, and we're about to get on to ETFs. ETFs allow for that simple diversification, simple access, cheap or very, very well priced access. I don't like using the word cheap, but easy access and affordable pricing to access all markets, whether it's international, emerging markets. You can go and buy an ETF just in the Indian market, or China, or Taiwan or Japan, or whatever you want. So I think the important thing for diversification and asset allocation, which is what we're going to get onto ETFs now, is it's not only diversification across the asset classes, so those 5 asset classes, it's also diversification within the asset class. So if you look at your portfolio and go, well, Australian equities 29%, I'm a sort of growth type person, 29% in Aussie equities, and you've only got CBA as your Australian stock, you are not diversified within that asset class. You've just got one bank. So what an ETF does for you is it allows you to diversify not only across asset classes, but also within the asset class. And that's really important. So we go to the next slide. Top 3 reasons, we've already talked about this, that people use our ready-made ETF portfolios, building wealth, retirement, investing for kids.
That's really interesting. Oh, sorry, Ron, I was going to jump in. That's a really interesting statistic there, that building wealth has passed retirement. From what I'm seeing, whether it's data coming from beta shares directly, whether it's Commonwealth Bank data, looking at our own data, there has been a huge uptick in younger people jumping into ETFs directly. And to me, it's a no-brainer. I've got a 23-year-old, I've got an 18-year-old, and jumping into the property market, or having said that, I know my 23-year-old's just bought a unit, but thanks to investing in ETFs, jumping into property, there's a huge barrier to entry there. Medium house price, especially in Sydney now, is 1.4 million. A lot of younger people are jumping into ETFs to start building wealth because they're thinking property is so hard to get into. How can I continue my journey of building wealth? By the time I save up for a deposit, you could be 30, 40. The idea of now jumping into shares, or more easily ETFs, has really taken off with younger generation. So it's nice to see. Yeah,
and I think that investing for kids is gradually increasing as well. I think that 6% next year will probably be closer to 10%. Next slide. I think most people know how exchange traded funds work.
I don't know about that, Ron. I reckon a lot of people don't know exactly the nitty-gritty.
You go for this one, Effie. Effie put this slide together. I think it's a great slide.
I do like it, although I think Mitch is in the background there writing, answering everyone's questions, put the story together. There's a really great story that Mitch has put together, basically just a real 101 guide around ETFs, and a lot of people not too sure exactly what is an ETF. I mean, how does it all work? When you say it gives me exposure to all these companies, how does it work? And so this was a little example in that story that we just turned it into a graphic. So let's say you've got $3,000 to invest, and you decide, okay, yep, I want to invest in something that tracks the ASX 200, the S&P ASX 200. They're the 200 largest companies by market cap. Let's say you want to, go into iShares. That's just one of the providers. You've got a ticker code there of IOZ. So when you go, and this is bought exactly like you buy shares, through a broker, or you can go direct with some of the ETF providers now as well. Or some of these are in our portfolios. If one unit, this is just an example, if one unit costs $30, then Sally's able to buy 100 of these units because she had originally $3,000 to invest. And so let's say that CBA made up 8.3% only of the actual portfolio there of that ETF. What it tracks a whole lot of the 200. It only makes up 8.3. Then you've got, it's worth the CBA $2.48. You had 100 units, 249. The rest of the money is allocated by the weightings of the other companies that the IOZ has. So that's just a really simple example to show you where your $3,000 gets invested and how it's spread across these 200 largest companies based on the weightings that's there.
Yeah, I think the important thing is that this illustrates, Effie, is that CBA is only one proportion, and it makes up the largest because it's the largest weighted out of the ASX 200, which is what IOZ tracks. But talking about what we're talking about before, which is that diversification across asset classes, also within an asset class, this one simple trade of IOZ gives you exposure to the top 200 market, by the largest 200 companies on the Australian Stock Exchange. So one trade, you get instant diversification across that asset class. And what we're saying is you can use all the free tools and the ETF scorecard report. So you set your goal, you work out the objective, the asset allocation of how much in Aussie shares, international shares you want, and then you can go and use our tools, which we're going to explain in the next couple of slides. But you can use our tools to go, rightio, I want to buy IOZ for my Australian equities exposure. I want to buy VAS or VGS or whatever it is for my international. I want to buy AAA for cash. So you can go and use ETFs to buy each of those different asset classes. And then by buying the ETF, if you're picking the right ones, you've got that instant diversification within the ETF. And you can buy ETFs just like any share on the stock exchange. They act very much like a managed fund. So as the name suggests, it's just an exchange-traded managed fund. And so, we love ETFs. When we first started 25 years ago, there was no ETFs. I think the first ETF was gold, and now there's tons of ETFs. So we go to the next slide, Effie. So the ETF landscape, you've got $213 billion in ETFs now. That's across.
I think about over 2 million Aussies now are invested in ETFs, Ron.
It's awesome. And they reckon that by 2030, that'll be at half, 500 billion. So it's growing very fast, ETFs. Yeah. 363 ETFs are listed on the ASX.
Sorry to cut you off. I think also, in the past, 4 or 5 years, we've been pretty lucky. We haven't had to have any risk. You could put your money in a bank account and, you could, without taking any risk at all, you'd be getting 5.5, 5.75. But I think as rates, when they do start coming down, that, other people who have not thought about this before may start thinking, well, okay, how can I get my money working for me, harder, and especially if you do have time on your side. So as you said, that number will only go up.
Yeah, correct. And I think there's a lot more ETFs. There's 67 new ETFs just launched in the last year. Given there's 363 and 67 launched in the last year, you can see how many more ETFs are being launched every year. So we're going to have a lot more choice. But just remember, not every ETF is like the other ETF. There are active ETFs. So you're not getting that instant diversification. It could be just a fund manager picking his 20 stocks out of the whole 3,000 stocks on the marketplace. So you've got to be careful what you're looking at and make sure you do the research and look under the hood and make sure you're getting what you think you need in your portfolio.
Yeah.
So 5-star ratings. So we made it a little bit easier. We've sort of like in that report and also in the ETF tool that I'm going to show you next, the 5-star ratings. So InvestSMART does 5-star ratings on every ETF listed on the Australian Stock Exchange. So what we look at is size of the ETF, fees. So we pick low fees. There was a comment before about fees within the ETF, and so the fees InvestSMART charge, which we're going to come back to which we're going to touch on in a little while, that's on top of these fees. So what you're paying us for is to do all the research on all the different ETFs. We're experts at ETFs. That's what we hang our hat on. We know which ones are good and the bad. We try to help everybody to do it for themselves, so you can go and pick them yourself. I remember going to a seminar back in the day, pre-COVID, when you could actually, hold in-person seminars, and now we do it via technology. But this accountant sort of like stood up and said, "Wow, all my clients are into your portfolios." And someone asked her in the crowd why. Well, they do all the work, they get all the tax reporting, they do all the rebalancing, and they charge anywhere between $55 and capped at $550 per year. So then you're also, with the ETFs we buy, there's also a fee that the manufacturer charges. But most of those fees for most of the portfolio, most of the ETFs we choose in those portfolios, it's sort of like 4 to 6 basis points, 0.04%. So the ones that we look at and are fees, I think everybody at the end of this webinar is going to get the gist that fees need to be kept low. We look at spread, we look at liquidity, we look at tracking error. So make sure if they are passive funds that they actually do what they say they do and they're tracking their index, similar to how we do it in our investment committee meetings. We look at outperform, and for the active ETFs, we look at outperformance. Their whole idea of an active ETF or an active fund manager is to outperform the benchmark. They take on extra risk, extra volatility, making sure they do what they say they're going to do. And so we give 5-star ratings. We've given 104 of those 360 odd ETFs a star rating of 5 or 4. We probably think investment grade is 3 stars and above. We've given a few ETFs a score of 11. Again, we think 1 year is very short term. So what we've done in the report for this ETF scorecard is we've also looked at 5-year returns, and our star ratings is based off 5 years returns, by the way, or 5 years performance. So have a look at that. The next slide, to make it even easier, if you don't get a chance to read that scorecard, you can also go to a free filter on the website. So if you go up to Insights and go to Tools and under ETFs, you will see that report. Plus, you'll also be able to put in different categories. So you can go in and go, well, what's Australian equities or what's international equities? It'll show you the ones that we think are 5-star rated. You can then click on those and then go and have a look behind the scenes and see if you like that ETF and choose it for your own portfolio.
Yeah.
So getting to the end, and questions are drying up. So anybody's got any questions, just start asking now. But don't forget Murphy's Law. So another thing that we make it really easy for you guys to do is through our portfolio manager. So you can put in your portfolio of ETFs. You can pick your risk profile, whether that's growth, balanced or high growth. We'll do the work for you and tell you how aligned your portfolio of ETFs and what you own aligns to what we believe a growth portfolio should look like. And if you're a little bit more sophisticated and, like Effie said, you don't agree with what our asset allocation is for a growth, you can choose custom. You can set your own target asset allocation, and then we'll track your portfolio of ETFs against that and tell you how closely aligned your portfolio is with your risk profile or your goal, your objectives. And so as that market fluctuates, we can show you where you're overweight or underweight a different asset class, and you can then go and trade that in your own portfolio that should now hopefully be outperforming the fund managers. So getting on to cap fees. So we already explained this. I just want to explain why we think this. So we haven't found another fund manager that actually caps their fees. It's unheard of. So if you invest $10,000 into one of our portfolios through us, you get all of the stuff we've been talking about today, that systematic investing process. You get to choose your portfolio. We then rebalance that. We work out what the best ETFs. The other thing we do in an investment committee meeting is, like last year, there was 67 new ETFs come on the marketplace. We look at those ETFs and go, well, is one of those better than the ones we already use in our portfolios? So we might decide to swap it out. We don't do that very regularly because there's obviously capital gains tax and tax implications to that. But if something extraordinary comes along that catches our eye, then we might do that. So all that rebalancing, full tax reporting at the end of the year, we do that for, if you invest $10,000, we charge $55. So it's 0.55%. And that caps out at $550, so $100,000. So if you invest $1 million, we still charge you $550. $10 million, $550. I think you get the picture. But that's what capped fees works like. Now, all of the stuff that we compare to our peers and whatever else, we base that on a $10,000 portfolio. Because,
well, that's, isn't it, Ron? Yeah,
we're not sort of like going, it's $1 million portfolio and therefore we rock because, our fees are probably even less and we'd really outperform the fund managers. But, so we're fair in how we compare to our peers. But we have a lot of investors, as you know, Effie, that are over that cap who are loving life because the more they invest over that $100,000, their percentage fees is coming down even lower and lower. Now, on top of that, as someone else explained before, you pay not extra. It's actually already worked out in the ETF you're buying or that we buy on your behalf. So internal to that ETF, they're charging 8 basis points or 4 basis points or 6 basis points. You don't pay on top of what you pay us, but there are fees internalized in those ETFs that we buy for you. So if we buy a Beta shares or a Vanguard or a iShares or a VanEck ETF, those manufacturers have got an embedded cost in that fund that you aren't charged extra as such, but your performance would be affected a little bit, obviously.
Yeah.
So that's how we make money. We make money not by making a fortune off high balance clients. We make money by making sure that we have lots of happy investors. And so for us, it's all about, one of our sort of major visions, I guess, when we started this business, Effie, as you know, was, helping all Australians reach their financial goals. So the more people that we get invested and make happy, then obviously that's how we make money. It's sort of like, more happy customers, the better for us.
Yeah, and I guess I think Paul sums it up nicely. I know he always talks about this in the board meetings that, it's not kind of rocket science here. It's a simple product that tracks an index that has a cap fee. And I think he calls them the Corollas of the world, which I love. It's just, we want it to do what it's supposed to do, and it is doing it. And if you're after just something that tracks an index that is, capped at fees, then we're delivering on that. That's what I love about it.
Yeah, well, it's systematic. That's what I like. I mean, I've got all my family money in there. Charlotte, my daughter, she's invested in the fund later. She's loving life now after 3 years. She's about to finish third year uni and she's got like $22,000 in her account. She started with 4,000. So anyway.
Well, I'm a journo, so I've got it everywhere. I've got it InvestSMART. I kind of pick up things like handbags. I've got everything.
So I guess coming up to the last two slides, it's like planting a tree. I know this is, probably a bit naff, but, forget market timing, forget all that. The best time to start investing is now. I think Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The sooner the better. Let compounding interest do the heavy lifting. Short-term noise and market volatility is irrelevant. If you follow this systematic investing process in your own portfolio or whether you invest with us, that's how we do it. You will, over time, as long as you've set your risk profile and your goals accordingly and you're invested in the right asset allocation. If you're just saving for an emergency fund and it's a couple of years away, putting all your money into international equities or into just one stock, you're bound to lose, at some stage. You might win the first time, you'll keep on doing it until you actually lose your money. If you systematically invest, this is the way you do it and you'll make your financial goals.
Yeah, and for me, look, I'm in the high growth, but I treat it like a subscription. But that's how I do all my investments, And the reason I say that is, bet your bottom dollar, you don't miss out on your Netflix payment, your stand payment, whatever. That just happens automatically. When it comes to my investments, I treat them all like subscriptions. And as Ron was saying, I put the noise. It's funny, I'm in the news cycle, so every day reporting and so on, and I hear all these headlines, but I've just got to put that out and just keep going. What's my goal? Treat it like a subscription, and just time in the market.
Well, it's also why super works, yeah. It's the fact that you're putting money in every month, and whether the market's high or low, you're still putting it in. You just don't know, and they're buying. Yeah. I love. We have a lot of members, Effie, who write to us and go, "Oh my God, the market's crashed." What's going on? You go, well, the market might have crashed, but you're diversified across asset classes, so you've lost whatever you've lost. And because we track the market, that's what you would have done. But for us, we go, you're in a diversified portfolio, so that means you're getting to buy units cheaper this month when you put in a little bit of extra money, and then next month they might be a bit more expensive, and that's called dollar cost averaging. And that's why super, when you look at it after several years, you go, wow, I've got that much money. So the difference with subscription, though, Effie, is if you look at how much you spend on subscription, your eyes would probably water.
I'm not advocating. Come on, I've only got two. Actually, I've only got two subscriptions. I've only got Stan and Netflix, and we've got a rule in the house here that we can't put another one on unless we drop one. So come on, okay.
Yeah. But at least if you got 5% on the subscription money you paid every month, at the end of sort of like 10 years, it'd actually be pretty good.
Are you telling me how to budget now, Ron?
No, not at all. No. How to invest, okay, last slide, or second last slide. To outperform the fund managers like InvestSMART, I think hopefully everybody gets the idea. Don't chase returns. Know your risk appetite and, more importantly, your time horizon. Diversification across asset classes, not within it. Compare apples with apples. So just because your mate or you saw a fund manager or something report that they made 30%, our international portfolio this over the last year made 30%. Yeah, over 10 years, it's more like 11%. That's more realistic. Yeah. Now, if you go and chase the 30% and then next year it crashes or it goes half or comes back to reality and you lose 10% or 20%, you're going to be upset. Whereas if you're diversified and you're doing that systematic approach to investing, you're not chasing those returns. So make sure you compare apples with apples. You can't compare your portfolio, that might be a balanced portfolio, with a short-term investment or medium-term investment horizon with something like Bitcoin or, your mate who won at the horse track, in 5 minutes. So make sure you're comparing apples with apples and don't get sucked into chasing higher returns for higher risk. Stay invested over the long term and add as much as you can and as regularly as you can. So that dollar cost averaging idea. So don't just invest 10 grand and then leave it. Even if you can add $10 or $50 or $100 every month, that's what's going to allow you to achieve those financial goals quicker. Rebalance regularly and keep your fees low. Questions and comments, please, and please get in touch. Our number there is our email. I think Mitch has told a few people we've got a live chat. That's not a robot. That's actually real people. So if you wanted to have a chat to us or email us or call us, we have real people here. The other thing I think, for our birthday was great to get our legendary service, most trusted and most loved from Finder. Nice. Which was our trifecta. It actually came in October, which was also our birthday for those three funds.
Perfect timing. Yeah, that's nice. And I guess also, if you are going to the ASX trading day, we will be there as well. So whether you're in Melbourne or Sydney, make sure to catch us, come past, say hi to us. We'll be there.
Yes, absolutely. I think that's next week in Sydney. No, this Saturday.
Next Saturday we'll be in Melbourne, and then the following Saturday will be Sydney.
Yeah. Is it this Saturday? 16th, isn't it?
Oh, sorry. Yeah, this Saturday. Better not miss it. Hey? Yes, this Saturday I'll be in Melbourne.
Mitch, is there any questions that you wanted us to ask? If you just chat them in the chat one.
Mitch has been pretty good in getting back to everyone very fast. Okay, well.
Okay, well, thank you, everybody, and I hope you have a good rest of the day. And by all means, give us a call, email us, chat us online, look on the website, and happy investing.
Thanks, Ron. Thanks,
you.
everyone. Thanks,
Effie. Cheers. Thanks, Effie.